Good afternoon. Thank you for joining us today for an SES Advisors webinar entitled Estate Planning Using ESOPs. I am your presenter for this webcast, Tabitha Croscut with the law firm of Steiker, Fischer, Edwards, and Greenapple. I'm out of the firm's Burlington, Vermont office, and I'm going to attempt to figure out how to go forward here. Just a quick disclaimer, everyone probably has seen these before, the Circular 230 disclosure, and just a bit about who I am. So I've been practicing in the ESOP area for almost 10 years now, and bring to the table some Marissa tax and corporate law experience. Worked with many, many different companies. Started my practice in Rochester, New York, and joined Steiker, Fischer, Edwards, and Greenapple, which is a ESOP boutique firm with offices in Rhode Island, New Jersey, Philadelphia, and Vermont here in Burlington. Coming to you all the way from Burlington, and speak at numerous different places nationally on ESOPs. So I certainly can answer any questions on that aspect, which is why I am speaking with you today. Also, in working with ESOP companies, we oftentimes come across the opportunity to help owners with their estate planning needs, as the ESOP is a great way of getting some liquidity for owners, and so it just naturally leads into the estate planning aspect of owners' lives. So that's why today we decided to put out here this presentation on ESOPs and estate planning. We're going to, it's really kind of the basics of estate planning. You add the complexity of ESOPs and the complexity of estate planning, and we all just kind of get overwhelmed. So what I'm going to attempt to do today is combine the two and let you take away, I hope, a few ideas on how you might be able to either help your clients or as an owner look to use an ESOP and leverage it with the estate planning needs of an individual. Just a couple of housekeeping items. I do have everyone muted so that we don't have to listen to background noise, and so you don't have to worry about muting your phones. We will be providing the PowerPoint slides for the presentation after we are done, and those will come out within the next day to everyone who attends. Everyone, I believe, who wants it will be eligible for the CPE credit, and SES Advisors will be taking care of that with folks through email, I believe. And certainly if you have questions, all right, I've been corrected, no CPE credit. Sorry, I take that back. If you do have questions, please feel free to put chat through the chat feature on here. I'm not going to promise that I will respond during the presentation here, because I'm just not that good at multitasking with the presentation and doing the chat. But certainly will answer any questions that come through, and if I don't get to them during the presentation, I will email people directly with the responses. Please, in addition here, please email either myself or Alice Simons, who you would have received some correspondence from for this presentation, if you would like the slides, I guess. We're not just going to send them out generally. So if you want the slides, let us know and we will get them to you. I think that is the rest of the housekeeping. So basically what we're going to do now is review some ESOP basics. I apologize for those of you who are experts on ESOPs already and have to listen to some of the basics, but it's really essential for those who are not well-versed to have some background before we leap into some of the complexities that the estate planning would lay around here. So with that, we will jump into first some estate planning basics. obviously, when we're talking about estate planning for an individual, one of the goals, I wouldn't say the goal, but one of the goals is obviously avoiding exposure to transfer taxes. The gift tax, the estate tax, the GST tax. That is really one of the objectives, is to use mechanisms, tools in the toolbox to help the individual to avoid the additional layer of tax that occurs at death. Second, protection of family and loved ones. Obviously, we want to make sure that the assets of an estate or of an individual are being transferred at death to those they intend to be the recipients of those assets, and not to those who they don't want to benefit from their assets that they've accumulated through hard work during their lives. And also, a third objective is to reduce the cost of the estate settlement. So we want to, if we can, in most instances, get the assets out of probate and passing outside, so we don't have to worry about that expense and the time that it takes to go through that process. So just recently, in the past year plus, on January 1st of 2011, the federal gift, estate, and generation skipping transfer tax exemption rose to $5 million. It's now in 2012, $5,120,000 actually, so a little bit higher. In addition, with that increase in the exemption, we also were granted the ability of portability with respect to the estate tax exemption, and this was a huge bonus for many couples. What the portability provided for estate planning purposes, it allows a decedent spouse to be legally entitled to leave their unused exemption amount to their surviving spouse. So what that means is that an individual, instead of having a $5 million estate tax exemption, then could, upon the death of their loved one, have the $10 million or their individual $5 million plus whatever was left of the decedent spouse. This was not something we had prior to January 1, 2011, so it's a great planning opportunity in the estate planning world. The downside is that or I guess the potential downside is that this new amount, the $5 million exemption and the portability, are set to sunset on December 31 of this year. There is a possibility that when the law sunsets, we could see a return to the $1 million exemption in 2013, and in addition, the estate tax rate would jump from the 35% that we have right now to 55%, which is a huge change. Now, we're obviously, I have no crystal ball, and I don't know anybody who has a crystal ball, so we don't really know what's going to happen with the law at the end of the year. Obviously, there are lots of speculation about this. It's possible that Congress does nothing and the sunset kicks in and we do go back to the $1 million exemption and the 55% estate tax. It's possible that they will just extend the current estate tax regime, so we continue the $5 million exemption, the portability, and the 35% estate tax rate. It's possible that there's some sort of compromise, and there's been talk of a possibility of a $3.5 million exemption and a 45% rate for estate tax, which was the rate in 2009, and then the possibility of them repealing the portability. And then, of course, there's always the option that Congress just repeals the estate tax entirely, or Lord only knows, they could do something entirely different that nobody's thinking of. So the options, as usual, are unlimited, and depending on who you ask, it'll be a different answer. My answer is we don't know, so you plan for the present. If you would be benefiting from the current $5 million estate tax exemption, then you should be taking advantage of that and planning for that. And these are these are, exemptions for individuals. So you're looking at what are the assets that would be in the individual's estate upon death, and if you can get $5 million out of that individual's estate prior to death, then you're going to avoid, currently the 35% tax, and in the future we just don't know what the rate will be. So planning for the now is good, so you don't have to worry about the rates in the future. So as the last bullet point says, planners should be talking with their clients about adopting document fixes. So certainly if you haven't reviewed, and you have, which would be great, if you have estate planning documents, if you have wills, trusts, all those estate planning tools in place, certainly you should be looking at those now and again, and not just putting those in the safe and waiting for Judgment Day. We want to make sure that everything is up to date and current. As the law changes, the changes require things in the documents to be modified. So what is an ESOP? So those of you who are experienced in ESOPs, again, I apologize if you stick with me for a little while here. We'll get to the estate planning piece of this. But at first, let's start out with what is an ESOP. I assume that most of the people on this call already know the answer to this. So an employee stock ownership plan, it is a retirement plan. It is generally entirely company funded. It does not require employee contributions, and very few plans on the private side would have direct employee contributions. All funds going into the ESOP are coming from the employer or the company. Employees do not own the stock. This is one of those fables out there. The ESOP is the buyer of the stock, and the employees do develop or accrue accounts within the ESOP in which shares of the company's stock is allocated. But stock certificates are never issued generally inside the plan to employees. They are issued to the trust for the benefit of the employees. So they don't generally have title to the stock. And again, it's a qualified retirement plan. So as a qualified retirement plan, the ESOP and the ESOP trust there is an entity, and it is regulated by the Internal Revenue Code the same way that your 401k plan or your defined benefit plan, profit sharing plan, money purchase plan, whatever you may have run across. Those are qualified retirement plans, and the ESOP is subject to similar rules with a few additional layers. So why do owners and companies use ESOPs? And there's depending on the number, the day, anywhere from 10 to 11,000 ESOPs, and they kind of come and they go. They are acquired, they sell, they terminate upon liquidation of a company. So our number is never constant, but somewhere between 10 and 11,000 ESOPs are out there today, and they all started in 1974 with the adoption of Marissa. So why are companies using ESOPs in addition to the fact that they are an additional retirement plan for companies to offer to employees? The key with ESOPs and the reason why we talk about them so much is because they make a market for owner stock. So, we all talk about the possible ownership transition or exit planning opportunities for an owner of privately held stock, who are typically the companies and the owners that we are working with, and those options, range from internal transfers to external transfers, with the ESOP being one of those internal transfers. This allows a company to really create that market and not have to go out and sell to an unknown third party, or sell to someone on the management team who may not have the assets to back up that purchase. You set up the plan, and based on the rules of the Internal Revenue Code, it does have the ability to buy up to 100% of a company's stock. second reason why ESOPs are popular is because owners can sell their stock to the ESOP and then defer the payment of capital gains taxes in accordance with Section 1042 of the Internal Revenue Code. So we call this the 1042 election, and we will go into quite a bit more detail because this is one of the ways that we leverage estate planning in the ESOP space. A third reason to borrow where the interest and principal payments are tax deductible. The ESOP is a wonderful way of borrowing funds from a bank to fund the acquisition of a shareholder stock, and then actually allow the company to take a deduction for perhaps, depending on whether the company is a C corporation or an S corporation, but to take a deduction for the interest and the principal payments as the ESOP note is paid. So it's, if you compare an ESOP purchase to the alternative that many companies use, which is a redemption, the company buying the stock directly instead of having an ESOP buy the stock from an owner. If a company is redeeming and buying the stock directly, there's no deduction or for the principal payments that may be paid to a bank when the company borrows the money for that purchase. But in the ESOP's case, there would be a deduction. So that's certainly an advantage. A fourth reason to enable owners to sell the shares while maintaining control of the company. This is a very popular one. It does allow an owner who may still want to be engaged with the company to continue to run the company, to be the president, to be on the board, to really control the day-to-day of what's going on with that company, while also getting liquidity through creating this ESOP market for their shares, which they could not have otherwise done through a sale to a third party. Or maybe they could, but in general they can't. Also is a tool to motivate, retain, and reward employees. There's certainly plenty of research out there showing that ESOP companies, in comparison to their non-ESOP counterparts, have a significant advantage over the non-ESOP companies in terms of motivating, retaining, and rewarding employees, both in good times and in bad times, just based on really good communication and participation of employees in the company. Now, that certainly can be done in a non-ESOP company, but given the stock ownership of the plan being held up for the benefit of employees, it's a lot easier to leverage that in an ESOP company. So we're certainly seeing that benefit where companies are leveraging employee participation. And it's also possible in an ESOP transaction to sell only a portion of an owner's stock. So the owner could get multiple, bites at the apple. So, when we talk about a private equity group coming in and buying a piece of the company, and then later allowing both the private equity group and the owner to sell in a second transaction, the ESOP creates a market so that an owner could actually sell a little piece of their ownership and do it over various years. So we certainly see companies who are sort of strategizing. Some owners come to us and say, we just want to kind of test the water, so let's do a 20-30% ESOP or even a 10% ESOP, see how that goes, see if it actually does drive the behavior the way we want it to, and if it does, we'll go the rest of the way. So the ESOP is a very flexible tool in that respect. So the best ESOP candidates, and I know there was a question that came in about a company worth about $1 million with 11 employees. I think that the best ESOP candidates are those companies who are at the top of their profession. They really are outshining the rest. They're profitable and growing. They're able to finance their own growth. You certainly don't want to see an ESOP in a company where it needs a lot of additional capital in order to grow, because that's just not well positioned for an ESOP company. It's not an over-leveraged company because you don't want to add the ESOP debt for the financing of the transaction and then take the company under. So we don't want to use an ESOP in a place where the company already is super leveraged. A company that has good financial reporting certainly makes an ESOP transaction that much easier, and certainly you need a deep and broad management team. So I think the common string throughout all of these points is that the best ESOP candidate, and we don't always get the best, we get ESOP candidates, but the best ESOP candidate is a company that would be saleable to a third party. An ESOP is not the best tool for rescuing a company that is going bankrupt. That's really not where it shines. The ESOP is, again, creating a market for shares in a company that is going to grow and thrive and really be a great asset for the employees of the company who would be looking to get their retirement from the company in the future based on shares in their account. In terms of the size of the company, going back to the question that was asked in the chat, a company that's about $1 million, I'm not sure if that was, in terms of revenue or in terms of value, is probably on the low side. I think that it always comes back to a question of do the advantages, generally from a tax perspective, outweigh the expense, because there certainly is an expense in doing a transaction and maintaining the plan on an annual basis. So the initial question for a smaller company is, do the benefits of that ESOP transaction outweigh the expense of it? At $1 million, and if I assume value, I think that's on the low side, and it would be hard for the tax advantages to actually pay back. So I would say that that's on the small side, but I would also recommend that you go onto the FCS Advisors website and fill out a feasibility questionnaire, and we can certainly give you a lot more detail that way. So that would be my suggestion. And I'm also happy to talk to you after the presentation if you'd like. Just shoot me an email or give me a call. Why are owners choosing ESOP? Again, we just kind of went through like the best ESOP candidates, and we talked about the major reasons why companies are using them. But I just want to put up here kind of a list, because I just wanted to point out that there are a lot of different objectives, and that's really what we're looking at, is what is the objective, the goal of the owners who are using ESOPs. And the top three that come up in most instances are an owner who is very concerned about leaving a legacy. They're very concerned about their employees. They don't want to move the company out of the location, because if they move the company, or if a buyer comes in and moves the company, you're going to have a lot of employees who were depending on that company who are now out of a job. So a lot of our ESOP companies are just part of the community. And the third major reason owners look to ESOP is because of the control, and we talked about this in the previous slide. But then just additionally, they're a good tool for diversification. Get a little liquidity. You don't have to sell all of your stock at once. You could sell a little bit. Again, avoiding and reducing income tax, and we'll get to that in a couple slides again. Controlling the deal structure. You really have little control over a deal structure in terms of all the details when you get into a third-party sale. You certainly have a little control at the beginning, and then you kind of lose that. So as the seller, in an ESOP transaction, you really get to call the shots in terms of the deal structure. So that's great, and it's very flexible in terms of its structure. Again, it's an additional retirement plan for employees and can increase productivity, on and on and on here. So I just wanted to make sure that we touched upon the fact that there are many different objectives that the ESOP satisfies. This is kind of along the same lines of business situations indicating that an ESOP might be a good tool for the owner. An owner who really just wants to continue working but wants some liquidity, is not ready to golf or for the rocking chair. The owner who wants management to run the company, so they want to kind of step back, let management run it, but they want to get their money off the table. Owner wants the lowest possible tax for himself and the company. Again, we've established that the ESOP is just in general a good advantageous tax vehicle in terms of a sale of stock. A big one, actually, there may not be a logical local buyer for the business. This happens a lot in the the professional services area, construction, engineering firms, architecture firms. These companies don't always have a third-party buyer, and so ESOP is a good tool for them. And owners want the employees to have stock as a reward and incentive. Again, going back to the concept that they have some concern for their employees. In terms of the family or the estate planning issues that come up where ESOPs are just identified as a good tool, you have a family where there's no logical heir. So there's no one working in the business. There's nobody that is interested in working in the business. And so you look to the ESOP to be that next shareholder and to allow the owner to take their money out of the company and still keep that business in place. If you have no logical heir, but the business is too large for gift or estate tax transfer, you can transfer the shares out, and we're going to talk about this, and kind of cap the gift or estate tax hit using the ESOP. We're going to, like I said, get to that. And then another common theme that we come across is some family in the business and some family out of the business, and how do you equalize between those family members. And the ESOP, again, creating the market for the shares allows you to use it as a tool to keep the ownership, with those heirs that are in the business, and yet take some cash out of the business through a sale to the ESOP to equalize and kind of put that either cash in trust or whatever the planning technique is you want to do to get it to the heirs that are outside the business. Some important details, and again, like I said, it's a really complex area, and I'm going to kind of go through these quickly, but you need to have some background of what we're working with in order to understand the estate planning aspect. So prior to 1998, the S Corporation could not have an ESOP, and now we're seeing many, and probably a majority of our transactions are S Corporations who are either their C Corps converting to S or they already are S, and they are adopting ESOPs. And just a note here before we get into why that is, there are unfortunately more planning opportunities in the estate planning area with a C Corporation versus an S Corporation, particularly when it comes to the 1042 election and using CRTs or charitable remainder trusts as the planning tool. Unfortunately, the S stock is not a good asset for a CRT, and we'll get to that in a minute. Question came up: how long does it take to convert a C Corp from an S Corp? It doesn't take that long in terms of the revocation. If you are an S Corporation, you can just file to become a C Corporation. You just need to do some planning because obviously you're going from a single tax entity to a double tax entity, and you want to make sure that that's a good thing for the company, and you want to watch out and see if you have any big tax issues as well. So it's not, in terms of the process, it is not a long process. In fact, unfortunately, there are occasions in which people inadvertently revoke their S election through issuing stock to an ineligible S Corp shareholder. So it does not take long at all. So S Corp shareholders are, like I said, the S Corp is a single layer tax environment. So the shareholders of the corporation are responsible for paying the tax. So the ESOP is a tax-exempt shareholder. So what happens is, to the extent that you have tax to be paid on the earnings of an S Corporation, the percentage of the earnings that would be taxable to the ESOP are not taxed. As a tax-exempt entity, that allows the company to really maintain whatever tax dollars would have otherwise been paid to Uncle Sam. So many of our companies are actually going from 0 to 100% in terms of the ESOP's ownership of stock. And the result of that is, if you have an ESOP holding 100% of the company's stock, the company is effectively avoiding federal tax And so if you think about that, if you have a company that is 100% owned by an ESOP, and it would have otherwise been paying $2 million in tax every year, that the $2 million is maintained in the company for working capital, for reinvestment, for equipment, whatever you want to use it for. It does not have to go into the ESOP. It's held in the company, and the company can use it as needed. So just a note here, once the debt is paid off from the ESOP transaction, the company really does become a cash cow. And we have many, many examples of companies that are in have this problem, actually. I was meeting with a company last week in upstate New York, and they actually have more than $30 million of non-operating cash on their books, just solely because of the, well, one, they're profitable, two, they are 100% ESOP-owned company. So imagine the possibilities when you have so much cash. And that really is the Grand Slam. The Grand Slam is this 100% ESOP-owned company where you're not paying tax on the company's earnings. And it's possible here, I guess the real Grand Slam here is that you can have a C corporation. You can be a C corporation, enter into an ESOP transaction, have the owner elect Section 1042, which I'm going to get into the details in a minute, but basically that means the seller or sellers do not have any capital gains tax so long as they have invested the proceeds of the sale in qualified replacement property, and we'll get into those details. And so you're having the seller avoid capital gains on the proceeds, and then now you're 100% ESOP-owned C corporation. You can convert that C corporation to an S corporation, assuming that you have not been an S corporation for 5 years, and you now have a company that's tax-free. So not only did the seller get deferred capital gains treatment, you also have the benefits to the company of the tax exemption. So then we get to the actual structuring and how this operates. And I think I'm going to take you to the chart here. But there are a couple different ways to structure, actually there's more than a couple. There are plenty of different ways to structure an ESOP transaction. And the reason why this is important is because the structure of the transaction takes you into the estate planning mechanics. So one of those structures is a one-day loan. And I'm going to take you here a couple slides ahead to the actual chart, which is just a little easier to explain this. When you get the slides, you can certainly read through this. But in a one-day loan transaction, what you have is a lender who's lending whatever, ABC Bank is lending $1.5 million to the company and also lending an additional $3 million of cash to the company. So there are two separate notes. And this $3 million note is what we call the one-day loan. So this is a typical structure that we use with our clients. So you have this $4.5 million loan to the company. The company is then going to loan that money to the ESOP, and so you have this $4.5 million note. The ESOP is going to use all of the cash, the $4.5 million of cash, to buy 60% of the company from, in this scenario, the selling shareholder. The selling shareholder then has cash in exchange for the stock that the ESOP now holds. That is a taxable transaction. They now would owe capital gains on the proceeds from the sale. The one-day loan piece of this is the selling shareholder doesn't keep the $4.5 million of cash, but instead loans the $3 million back to either loans it back to the company or pays off the company's debt, but essentially is loaning the $3 million to the company. And I'm going to go ahead one more slide here. So then what you have is the selling shareholder, when they loan the money back to the company, that $3 million, what they take with the note is warrants, detachable warrants. So the company gets the $3 million of cash to pay back that one-day loan, which can either be 1 day later, 2 days later, 3 days later, whatever the bank is comfortable with. But the seller gets back a note for the $3 million and warrants. And this is where the planning opportunity arises. First is the question of, do you have the opportunity here? I'm going to go back a slide. You may have an opportunity here to elect 1042, the deferral of the capital gains tax if this is a C corporation, even though at the end of the day the selling shareholder does not have $4.5 million of cash in hand. Given this transaction, the exchange of $4.5 million of cash for stock, the seller could still elect that 1042 treatment. But the second planning opportunity is with the warrants. Now the seller has these warrants, which essentially is a way of giving the selling shareholder, a higher rate of return. The warrants are structured in a way that they will pay off once the seller note is repaid to allow the seller to get some additional cash based on some expected rate of return and the company's actual growth of its stock value. And essentially, we're working somewhere between 9 and say 13%. I guess I've seen it as high as 15% in terms of the internal rate of return between the interest rate on this note and what the seller receives later or is expected to receive based on the warrants that are issued in the financing. So then the other options, so that's one transaction structure. The other transaction structure that we see a lot is the redemption with the ESOP purchase. And this is pretty simple. This is the company actually redeeming the stock, and most of the time this is used in the S corporation structure because you're not worried about giving the seller the 1042 election, so you don't have to sell directly to the ESOP. So the seller is selling directly to the company in a redemption, and the seller is taking back an installment note with warrants. Instead of going through that whole one-day loan process to make sure that the seller can get the 1042 treatment, you're just taking the note immediately with the company as the seller. Or as the company issues to the seller the note with the detachable warrants. Third bullet point here, the seller can't take advantage of the capital gains deferral because they're not selling to the ESOP, but to the company, and so that's why you see it in the S corporation. And the warrants are creating additional capital gain, their tax capital gains rates. So the seller's loaning back funds to the corporation, and this is really just an explanation of what I've already indicated, with the point of the warrants being to give that higher internal rate of return based on the risk that the seller is taking holding paper from the company. Now, depending on the structure of the transaction, warrants can have, in the last bullet point here, it's just a note, warrants have OID implication in the one-day loan setting. That is the first transaction structure we looked at, because it's essentially a loan. They're exchanging, giving the company a loan and taking back a note, whereas in the redemption setting, the warrant is actually being issued as consideration for stock. So the warrant is increasing the gain in the second scenario. So a bit here on the 1042, because I do want to jump here quickly to the estate planning. 1042 is an opportunity for the seller to defer their capital gains treatment. There are a lot of requirements here. The basic ones are 30% of the company's stock is held by the ESOP after the transaction. You can have one or more sellers getting into the 30%, and once you're over the 30% bar, any sale after that to the ESOP would qualify, assuming you've met the other requirements. And again, the point of the 1042 is to defer the capital gains treatment. So this is just a bit more on what are the requirements. I'm going to just jump right through these. Again, this is the qualified replacement property. Once the seller gets the proceeds from the sale, they are required, in order to get that tax-deferred treatment, to invest the proceeds in qualified replacement property, which is just a general statement operating U.S. company stocks and bonds. So this is some more detail on that. Now, one of the essential things for estate planning purposes is if there's a disposition, which means the seller actually liquidates or reinvests the QRP, there would be a tax at that point. That no longer would the capital gains tax be deferred. From the estate planning perspective, a gift is not considered a disposition under the Internal Revenue Code. So we have the ability to actually transfer the qualified replacement property and use that in the estate planning for an individual who's holding the QRP. And the capital gains tax is only triggered when you actually liquidate or dispose of the QRP. And there's a kind of a list of what is considered a disposition. One of the qualified replacement property investments is floating rate notes. These are a little complicated, but essentially an owner can buy a bond and then margin against it so that using 10 to 15% cash down, they can get the full value. I'm sorry, not the full value, 80 to 85% of the value of the sale through a margin against the floating rate note. So this is a technique that requires a bit more detail, but the point here is that the floating rate note is one of the tools we use. It's kind of the result of the sale to the ESOP and is one of the items that we look to get out of the individual's estate through our estate planning tools. And the home run here is that if you have 1042 replacement property or QRP at death and you haven't liquidated or disposed of it, it gets a step up in basis, and your heirs would not pay the capital gains tax, and you would not have paid, so you escape that capital gains tax. But it is going to be in your estate unless you get it out, so you're going to be paying estate tax. So then we get to the estate planning opportunities, and I realize that we only have a few minutes, but I am going to run through some of the basic techniques here, and these are only a few of the tools that we have, but a few of the things that we have used with our clients. And just as an example of an owner that we worked with in the recent past, was a single business owner. He owned 100% of a C corporation, so we had a lot more tools at our disposal here. The business was valued at $45 million, and the transaction structure we used with this company, we looked at quite a few, but we used $15 million of bank financing. And then the seller, the single business owner, took back $30 million of seller debt. And this was one of those redemption transactions followed by a sale to the ESOP. So the warrants here, the note had a 4% interest rate, and then there were detachable warrants. The warrants, I think, were valued at the closing at $1.7 million, but the projected value of the warrants was looking to be $40 million at the end of a 10-year period when they were exercisable. So a significant payback to the owner for the risk of holding that note. And again, those are the real numbers from that transaction. So at beginning the process with the owner, we see this quite a few times. Unfortunately, people don't really think about, what's going to happen when I pass. So they don't put in place all of the estate planning documents that they should. So I was just meeting with a company recently, and we were talking about, how do you want your stock to transfer when you pass, and they really had no idea what that meant and didn't realize that they had nothing in place to really speak to what happens to the stock, and so it would really have to go through the probate process, which could essentially put the company out of business if there was no really strong-minded manager to manage that process. So we want to make sure that when we're talking to these companies, even if they don't do an ESOP transaction, that they have in place the appropriate wills, trusts, powers of attorney, et cetera, to make sure that their businesses are going to be able to pass to the heirs they want them to. That hopefully we can get them some of the value out of their estate so they don't have the estate tax impacts. And so that's the first step, making sure they have the right documents in place. And it's usually the first question, or not the first question, it's the last question I ask before I leave an initial ESOP meeting to make sure that that need is taken care of. So one of the tools in the estate planning toolbox here is the Charitable Remainder Trust. So for those who don't know kind of the details of this, the Charitable Remainder Trust is really a creature of the Internal Revenue Code. And what happens in the CRT, as we call it, is the donor would make a gift and retain either annuity or a unit trust interest for a period of years that's really required to be no more than 20 years or the life of the grantor or the donor. At the formation of the CRT, the charity's interest is also required by the Internal Revenue Code to equal at least 10% of the assets. Essentially, you know, the CRT is going to be paying the donor a percentage of either the value of the stock that is put into the CRT through the annuity interest, or a percentage of the annual value of the trust if they're using the unit trust interest. And at the end of the CRT, the assets actually pass to the charity. So the donor is going to be getting some income off of the CRT, the stock that they put in the CRT for a period of time, and then at the end, whatever remainder, as we call it, is left, passes to the charity. The tax incentive here is that the donor is going to get a deduction for whatever they put into the CRT, and that deduction is going to be based on IRS interest and mortality tables when the donor makes the gift to the CRT. And basically those tables are going to be looking at what is the donor's mortality, what is today's interest rate, and the deduction is really the present value of the remainder interest that would be expected to pass to the charity. So as a tool in the kit, I mean, this doesn't necessarily have to be, you know, involved in an ESOP transaction, but it is a tool in the case in which you have an owner or a seller who is interested in getting some of their assets to charities. This is a wonderful tool. One of the drawbacks is it can only hold, the CRT can only hold C-Corp stock. So if you have an S corporation, the CRT is not going to be useful. Now the CRT in the ESOP case, basically pre-ESOP transaction, the owner is going to gift the shares that they want to sell, the value they want to kind of contribute to the CRT, and then they'll take a charitable deduction for that gift to the CRT. The CRT is then going to sell the shares to the company. So in our transaction here, the scenario of the $45 million company, the CRT would be involved as a seller, would sell directly to the company, and the owner would also be selling. So the two parties together would be selling all of the stock, and whatever portion of the stock the seller wants the CRT to have, you know, value for, that's what the CRT would be selling. The CRT, the way we structured it, would be taking back the promissory note and not cash, while the owner is going to be taking back the cash. Now, the key here is that we're really shifting the risk. So the owner is going to get the cash, which obviously there's no risk of, if they have it in their hands. And it could be that the owner sells directly to the ESOP and gets the 1042 tax deferral treatment. But if they don't, they still have the opportunity to get the deduction and reduce their tax liability through the deduction of the gift made to the CRT. But the other key point here is that by shifting the note to the CRT, it's the CRT that's going to take the risk that there would be a default on the note, and yet the seller still gets the charitable deduction and the ongoing you know, annuity off of the CRT. So that is one tool. You can combine, and I kind of alluded to this, you can combine the 1042 one-day loan structure to reduce the income tax. So you can have the seller selling to the trust, taking advantage of the tax-deferred treatment, and then also you know, using the deduction from the note, the stock transferred to the CRT, and then having the CRT hold the note. think I skipped a slide here. Go back. Maybe not. So then after the transaction, there's the other tool that is more readily available and just more prevalent, I would say, is that in a transaction where you're selling less than 100% of the company, you might take advantage of the fact that you can gift shares to whoever it is at a lower depressed value. So the value of the stock of a company post-ESOP transaction, assuming that there was leverage or there was cash flowing out of the company, the value of the company is going to be less. So the shares are going to be valued lower, and this is a great opportunity to transfer the stock out of the individual's estate to avoid any future estate and possibly gift tax implications if you can get it within the $5 million exemption at a lower value. So you can get more out at the depressed value, which is always what we're trying to do in estate planning. This notes, you can't just use the valuation firm's ESOP opinion. We certainly have seen sellers that have done that because they don't want to pay for an additional valuation opinion on the day after the transaction. But it does allow a more effective gifting through the reduced value. I also want to mention that you could leverage the transferring stock to an LLC or an LP, and then have the LLP or the LLC participate in the sale transaction and take advantage of the 1042 tax deferral. And then you could gift the units of the LLC or the LP, which now holds the qualified replacement property. You could then gift the units of those entities to whoever it is, and that would be subject to additional reduction in value based on the lower value of those LLC or LP units. So you've effectively reduced the value of the stock through the leverage of the sale and then through the valuation of the LLC. I hope that was clear. It seems kind of convoluted, but I'm trying to whip through a couple of these here. We have about 7 minutes left. So then there's the family limited partnership and LLC. So I was just speaking to that. In the estate planning arena, you have the ability to use the FLLPs and LLCs because they are subject to the lower value. So transferring units of those types of entities helps us to transition assets out of the estate at a lower value. So at the bottom here, it's not on that slide, you can gift the family limited partnership interest after a 1042 transaction without creating a disposition of the QRP. Remember that when we were talking about 1042, it doesn't trigger the tax. So this is, back to the example I was talking about, a great opportunity to have the QRP put into the FLP or the LLC and then transition it or transfer it, gift it out of the individual's estate at a much depressed value. Now the FLP area is definitely has a lot of IRS scrutiny and there are a lot of requirements. So you just have to be very careful with how you document both the FLP and the transfer documents and the whole transaction there. One of the other opportunities with the charitable remainder trust, kind of flipping back to this, with QRP. So we were talking about using the charitable remainder trust before the transaction. This is post-transaction. You could have the owner gift the 1042 property, that is the qualified replacement property, to the charitable remainder trust and get a deduction after the transaction. And then the key there is that when the CRT disposes of the 1042 property, it's not going to pay tax. And the donor is going to pay tax only if the property comes out of the CRT. So you're transferring it in, and then the donor would have the ability to kind of control when they're going to be taxed on it, even though the CRT can liquidate that qualified replacement property a lot faster than the actual donor could. And I guess the key here is that if you are working with clients, or you are a seller that has those floating rate notes, that's where we see this most logically happening, is if you have a floating rate note, you're getting a little concerned, or you work with an owner who's a little concerned and about some volatility in the floating rate note, you might take advantage of transferring the floating rate note to CRT. The CRT can liquidate that floating rate note, and then it does not pay tax on it. The CRT can reinvest the proceeds from that liquidation, and the donor would only be paying taxes as they're paid the annuity or the unit trust as it comes out. And then at the end of the term, whatever's left in the CRT would go to charity. So it depends on what you're willing to take as the QRP holder, the original QRP holder. But that is a good opportunity for someone who has a little concern about the floating rate note, or maybe you just want to have the floating rate note for 10 years, see what happens. Maybe this is the next step after that. All right. And the other very important tool with ESOPs here is, again, going back to the transaction with the warrants. It's a great opportunity for planning. Even if the transaction has occurred, you can still gift the warrants. But immediately after a transaction, a sale of stock, or the relending of the money to the company in the initial structure of the transaction, the warrants are at their lowest value. So that is the time when you want to transfer them out of an individual's estate. You want to get them out at the lowest value so you can reduce the $5 million exemption as little as you can, so you can get more out for less. So in our example, the warrants, I said, were worth about $1.7 million, and they were projected to be about $40 million in 10 years. So the question with that company, with that owner, was what were the possibilities? And there were three that we kind of looked at and played with. One was the owner could just use the gift exclusion that I was just saying, the $5 million, to get them out of the estate. They're $1.7 million, just transfer the warrant to someone outright, and reduce your $5 million exemption by 1.7. The second option was you may want to gift it to a long-term trust. So you may want to, and we are working with an owner on this actually, transfer the warrant into a long-term trust. Make sure that you use a trust that is in a state that does not have the rule against perpetuities, or has a very long life expectancy rule. And then you can use other tools at that point. Maybe you just want to have the warrant pay some amount of income to individuals for a very long time, and it just kind of lives on and on. Or the third option is you may want to put some of the warrants inside an irrevocable insurance trust for premium purposes in the future. And a lot of people say, well, why do I want to buy insurance? I just sold. I'm not participating in the company. That doesn't make sense. But the reason why we would have an owner buying insurance is because if you have warrants, that means you also have a note. And in most instances, the owners who are taking notes, they're still involved in the business. And if something were to happen to them prematurely, that company might not be able to produce the income to pay off the note that is likely still outstanding. So the insurance is a way for the owner to make sure that they have the liquidity that they were expecting. And the warrants are key here because you can have the donor actually loan money to the trust. Just take, if they've got in our example, there was some cash at the table and then the note and the warrant. The donor actually takes some of the cash, uses that in the trust to buy life insurance, and then down the road, When the warrants are paid by the company, the warrants inside the trust are used to pay off the loan. So using the combination of the cash and the warrants that are received at closing, you can use those to buy the life insurance policy to protect against the premature passing and then resulting lack of liquidity. I think at this point, there was one more item that I wanted to go over, and that is grants. The slides basically tell the story here. So if you've asked for the slides, then you will be able to read through this, and I'm happy to talk with anybody about it. I'm not going to go into it because I think we're out of time and I don't want to run over. So I just want to say thank you for joining us. I hope you got at least one new possibility that you can share here with clients or for yourself in terms of what the estate planning opportunities are. Please feel free to email me, call me with any questions, or if you have particular other planning methods, because there's certainly plenty more out there. And if you have any questions about how you might combine those with an ESOP transaction, we'd be more than happy to work with you on that. And I hope you all have a great day.
Premiumbeat.com